One company lost over $800 billion in value in a single day. Not over a year. Not over a decade. One day. And here's the strange part. The very next week, people lined up to buy shares of that same company anyway. Why would smart, careful people hand over their money to something that had just proven it could vanish overnight? The answer isn't about luck. It isn't about gambling either, even though it sometimes looks that way from the outside. The answer is hiding inside a system that quietly touches almost every part of your life, whether you have a bank account or not. By the end of this video, you'll understand exactly how that system works, why it can make people rich, why it can wipe out fortunes, and why almost nobody explains it properly to beginners. Let's start at the beginning. Picture a harbor in Amsterdam in the year 1602. Ships are being built to sail to the other side of the world, hunting for spices worth more than gold. But there's a problem. A single voyage could cost a fortune, and a single storm could destroy the entire ship. No one person, not even the wealthiest merchant in the city, wanted to risk everything on one voyage. So they came up with an idea that would quietly reshape the entire world. Instead of one person paying for the whole ship, thousands of people could each pay for a tiny piece of it. If the ship came back loaded with treasure, everyone who paid got a slice of the profit. If the ship sank, no single person lost everything. The loss was spread out. That tiny piece of ownership had a name. A share. That's the whole secret, right there at the start. A share isn't a lottery ticket. It's a small piece of something real, a business, a ship, a factory, a company. When you own a share, you technically own a sliver of that business. The company from that harbor became the Dutch East India Company, and it's now considered the first business in history to sell shares to the public on a stock exchange. But that's only half the story. Because once people realized they could buy and sell these tiny pieces of ownership to each other, something even stranger happened. Imagine a marketplace, but instead of selling fruit or fabric, people are selling pieces of businesses. That marketplace is the stock market. Here's where things become clearer. A company like Apple, Nike, or Tesla is divided into millions, sometimes billions, of tiny pieces called shares. If you buy one share of Apple, you now technically own a microscopic slice of every iPhone sold, every store opened, every dollar of profit made. You don't get to walk into an Apple store and demand a free laptop. But you do own a piece of the company's value, and that value can grow or shrink depending on how the business performs. This is where most beginners get confused, so picture it like this. Imagine a mango orchard owned by 1,000 different people, each owning a single tree. Every season, each tree produces mangoes. The tree owners don't sell their trees every time they want money. They simply collect the mangoes their tree produces. In the world of stocks, those mangoes are called dividends. Some companies share their profits directly with shareholders this way, paying them a small amount of cash simply for owning a piece of the business. But not every company works like this. Some companies, especially fast-growing ones, keep replanting their profits into more trees instead of harvesting mangoes right away. Instead of paying dividends, they pour money into expanding the orchard itself, hoping the whole forest becomes more valuable over time. That's why some investors chase mangoes, and others chase forests. But there's a bigger mystery still to solve. If a share is just a small piece of a company, why does its price jump up and down every single day, sometimes wildly, even when the company hasn't changed at all? Here's where things get strange. A company's factories don't disappear overnight. Its employees don't vanish. Its products don't stop working. Yet the price of its stock can swing 5% in a single afternoon. The reason isn't really about the company. It's about expectation. Think of it like a crowd trying to predict the future. Every single day, millions of investors around the world are making tiny bets about what a company will be worth 6 months from now, a year from now, a decade from now. When people believe a company will grow, more of them want to buy its shares, and the price rises. When people fear a company will shrink, they rush to sell, and the price falls. This means the stock market isn't really a measurement of what a company is worth today. It's a live, constantly shifting guess about what a company might be worth tomorrow. That single idea explains almost every strange headline you've ever seen about the stock market. A company can report record profits and still watch its stock price fall, simply because investors expected even more. A company can report a loss and still watch its stock price rise, because investors expected something worse. This is the part almost every beginner misunderstands. The stock market doesn't reward good companies. It rewards companies that beat expectations. And once you understand that, an even bigger question appears. If prices are just guesses about the future, what happens when millions of guesses turn into panic at the exact same time? Picture the market as a landscape with seasons, not unlike nature itself. Some years bring long stretches of sunshine, where prices climb steadily and confidence grows. Investors call this a bull market, a season of optimism, growth, and rising value. Other years bring storms, where fear spreads fast and prices fall sharply. Investors call this a bear market, a season of retreat, caution, and shrinking value. The most famous storm in stock market history hit in October 1929. In the days that followed what's now called the Great Crash, the U.S. stock market lost a massive portion of its value within a matter of days, wiping out fortunes almost instantly and helping trigger the Great Depression, a period of economic hardship that lasted for years afterward. But storms don't always come from the same direction. In 2008, a crisis in the housing and banking system caused a global crash that erased trillions of dollars in value and reshaped financial regulation for a generation. Then, in early 2020, the world watched the market crash again within weeks as a global pandemic shut down entire economies almost overnight, only to watch it recover with unusual speed once fear gave way to adaptation. Every storm looks different. A banking collapse, a pandemic, a bubble bursting. But they share one thing in common. They all remind investors of an uncomfortable truth. Owning a piece of a company means sharing in its risk, not just its reward. This brings us back to that $800 billion mystery from the beginning. Because sometimes, the storm doesn't come from bad news at all. Sometimes it comes from something far stranger, a crowd of ordinary people deciding to challenge the biggest investors in the world. In early 2021, a struggling video game retailer called GameStop became the center of one of the strangest events in stock market history. Large, wealthy investment firms had bet heavily that GameStop's stock price would fall, a strategy known as short selling. In simple terms, they borrowed shares, sold them, and planned to buy them back later at a lower price to profit from the difference. But a massive wave of ordinary, everyday investors, organized largely through online communities, noticed this bet and did the opposite. They bought GameStop shares in huge numbers, driving the price up instead of down. As the price rose, the firms that had bet against GameStop were forced to buy shares back at much higher prices to limit their losses, which pushed the price even higher in a chain reaction. Within days, GameStop's stock price had multiplied many times over, and some of the world's largest hedge funds lost billions of dollars. It was a rare, almost cinematic moment where the stock market stopped looking like a quiet system for long-term investing and started looking like a battlefield. This event revealed something important. The stock market isn't only shaped by company performance or economic seasons. It's also shaped by human psychology, crowds, emotion, and sometimes, collective defiance. But not every viewer watching this wants to understand crashes and chaos. Most people simply want to know one practical thing. How does someone actually become part of this system in the first place? Here's where the story becomes personal. You don't need to be wealthy or work on a trading floor to own a piece of a company. Today, anyone with a smartphone can open a brokerage account, a kind of digital gateway that connects ordinary people to the stock market. Through that gateway, a person can buy a share, or even a small fraction of one share, of companies they recognize from everyday life. The coffee shop chain they visit. The phone in their pocket. The streaming service they use at night. This is a dramatic shift from just a few decades ago, when buying stock often required a phone call to a broker, a fee for every trade, and a minimum amount of money most people didn't have sitting around. This accessibility is exactly why understanding the stock market matters more today than ever before. Retirement accounts, pension funds, and long-term savings plans are often quietly invested in the stock market, whether people realize it or not. Even someone who has never bought a single share may already have a financial future tied to how these markets perform. That's the quiet power of this system. It isn't just for Wall Street traders in tailored suits. It's woven into the financial lives of millions of ordinary people, often without them fully realizing it. But accessibility comes with a responsibility too. Because the same system that built fortunes for patient, long-term investors has also wiped out impatient ones who treated it like a casino. So let's return to that opening mystery. Why do people keep buying pieces of companies, even after watching those same companies lose enormous value overnight? Because the stock market was never designed to be predictable day to day. It was designed to reflect the long, slow story of human ambition, businesses growing, failing, adapting, and reinventing themselves over years and decades, not hours. The investors who panic over a single storm often forget the bigger picture. Historically, despite wars, crashes, recessions, and even global pandemics, the overall stock market has trended upward over long periods of time, not because prices never fall, but because human innovation, business growth, and economic recovery tend to continue over the long run. That doesn't mean every company survives. Many don't. It doesn't mean every investor wins. Many lose money, especially those chasing quick profits instead of understanding what they actually own. But the core idea remains beautifully simple, even after everything we've explored. A share is a small piece of a real business. Its price reflects collective belief about the future. And that belief can shift from confidence to panic and back again, sometimes within the same week. So here's the biggest lesson hiding inside this entire story. The stock market was never just about numbers flashing on a screen. It's a living reflection of human confidence, fear, ambition, and imagination, all playing out in real time across millions of decisions every single day. Understanding it doesn't mean predicting it. Even professional investors get that wrong constantly. It simply means understanding what you actually own when you buy a share, and why its value might rise, fall, or vanish overnight. Now here's a question worth sitting with. If a company's stock price is really just a reflection of what millions of people believe about its future, what does that say about the difference between a company's true value and its price on any given day? Let us know what you think in the comments.